7:30 p.m. only on Bloomberg Quint.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. It's Wednesday morning. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. India's largest stock exchange, NSE, plans to extend derivative trading hours till 11:55 p.m. subject to regulatory approval. Asian Paints delivers a strong first quarter despite rising input costs. The company's decorative paint segment saw double-digit volume growth. Larsen & Toubro, Bharti Infratel and Hero MotoCorp are the nifty companies that will report numbers today. And the country's largest equity asset manager, HDFC AMC, offers its own shares to the public. The 2,800 crore IPO opens for subscription today. And well, from the primary markets table, that's probably the largest piece of action that we'll see over the course of the next few weeks. But let's take a look at the trade setup for the day today. Seems to be an interesting day of trade because the handover from the US markets was mixed. Nasdaq was doing very well until most part of the trading day, then came off. The numbers at the global end of the spectrum looked reasonably okay, but Nasdaq did come off. Alphabet and some of the others led the way on the earnings front, and therefore the US market shut shop very well. Asia is painting a mixed picture. The SGX Nifty in early trade yesterday, or in rather late trade for our markets yesterday, was showing nudging the new highs. We may well start off at those levels as well, but for now, it's showing that we are just shy of those, and that's what we did yesterday as well. On a closing basis, we closed at record highs. We are just shy of all-time high levels on an intraday basis, which is 11,171 point few decimal points. So just shy of that, and if the SGX Nifty fails to become a lead indicator and we do start off well, then we'll start off for the Nifty as well on all-time highs. And the markets are inching higher the last few days, despite underperformance from heavyweights like Reliance, HDFC Bank, HDFC. These guys are not performing now. It's a completely new set of stocks which are leading higher. And the most telling part about trade the last 2 days, and in particular yesterday, was the kind of market breadth that we saw. Mid-caps led the gains. The market breadth was arguably the best that I've seen in the last couple of weeks. And then I was trying to look at certain pockets at the broader end of the spectrum wherein the trade activity was frenetic. So the Adani Group, the last 3 or 4 sessions has been on a boil literally. Adani Enterprises has gained some 75-80% in the last 2 weeks. Yesterday, the volumes were much higher than the 20-day average. So for the entire group, the volumes are substantially higher, and Enterprise is about 4 times, but the percentage mark for delivery was substantially lower. But this was not all. A clutch of other mid-caps went up, some without reason, some just because of the fact that they were beaten down. So the railway stocks were a case in point. Texmaco Rail, Titagarh Wagons, both locked on a 20% upper circuit. Volumes 13 times and 5 times the 20-day average. Delivery volume slightly better for Titagarh, but again, nothing too substantial. So a lot of trading activity, not enough delivery-based buying that we saw. But yesterday, the rising tide carried almost all the boats along with it. And specific pockets are bouncing off from key support levels. Remember, yesterday we were talking about how the mid-cap index was resting at some key support levels. We've already seen signs of that happening in select pockets. So I've chosen, for example, the consumer durables pack. Pull up Havells, pull up Whirlpool, pull up Symphony. And that chart shows you, if you look at the fag end of the chart, you will see that the stocks were resting at some key support levels on the RSI and have bounced off post that. So they've really shot up once they got a bit of a leg up. Similarly for Havells, similarly for Symphony for Whirlpool. All the charts are very, very similar. All the stocks were resting at key support levels, either the 50-day or the 100-day moving averages, and have substantially bounced off from there. So interesting moves there for a lot of mid-caps. Let's see if that lasts or not today. What's to be watched today? A clutch of numbers. Remember, this week about 13 odd companies come out with numbers. Yesterday we had 2 reporting. Today we have 3 nifty names and a clutch of mid-caps which are important as well. So Bharti Infratel, Hero MotoCorp in particular will be very, very important to watch out for. And L&T, it's heading into the earnings season very, very strong. The last 2 out of the last 3 days, it's had some good gains. Let's wait and watch if that persists. But the mid-cap end is not devoid, or the non-nifty name is not devoid of some very big names. So Ambuja, JSW Steel, Jubilant FoodWorks is an interesting one to watch out for. Ambuja is very important too. And let's see if their realization story also matches ACC and Ultratech, in which case that story might well turn out true for the cement pack. Then there is PVR. Maybe not, the results are not as important as the court verdict today, but all eyes will be out on what PVR manages to do. Tata Elxsi has been a strong mid-cap IT name. It'll be interesting to see what that one does in the session today as well. And as I said, it's not the results for PVR necessarily, but the verdict might be an important one. The court verdict that comes out today might be an important one, and if it goes against the multiplexes, then there might be some further hits. I won't dwell too much on it. Saloni will come in and tell you all about the numbers out there. However, the stocks to watch in the session today at 9:15, what you watch out for: Asian Paints. The numbers were above estimates. Margins expanded. It was a very solid quarter. We'll get in Yash to talk about this, but very solid quarter, so do watch out for that. Symphony, I thought the numbers were very disappointing. Yes, they prepared the market for a disappointing show this quarter, but it was worse than what most people anticipated because a disappointing revenue growth impacted all the heads. The guidance was very weak. I was on the con call, and the management was not confident about even a double-digit number growth on the domestic business for the rest of the quarters. That speaks volumes about what's happening within the air cooler industry. But this shouldn't augur too well for Symphony. I know that the stock has corrected quite a bit from those 1900 odd levels to 1400, but if you can't grow double digits as well, or if you can't confidently paint that picture right now, maybe, just maybe, the street might be a bit disappointed. Let's wait and watch. My reckoning is that it could open up a bit lower, but let's wait and watch what happens there. Hexaware came out with numbers reasonably okay, but for margins, just getting you a Credit Suisse value note out here. They are saying that they are cautious because the current valuations are high given the high client concentration, the lopsided nature of growth, and some concerns on margins. That is what Credit Suisse believes Hexaware is going through, and therefore their view is cautious on Hexaware. We'll hear the management at 8:35 today, so that's an important one too. And Music Broadcast, they've announced a buyback, about 2.5% of the paid up capital at 385 rupees. Let's wait and watch if that reacts in the session today or not. However, what's lined up on First Word? That's a collection of the top editorial stories that we believe we should bring to you. It's time market participants and financial journalists like us prepare for longer working hours. NSE has proposed a second window for derivatives trading till 11:55 p.m. in the night. We'll talk about that first up. Asian Paints delivers a strong first quarter. Yash Upadhyay Johnson with the key takeaways and the growth drivers. There is no good news expected from telecom sector earnings as competition continues to hurt wireless operators and consolidation amongst them hurt star companies. So Amit Sarkar has put together what analysts are pricing in on the eve of the numbers from Bharti Infratel. And a possible cap on food and beverage prices in cinema halls may deal a blow to multiplexes. Saloni Dhanuka will join us with the math and how much further a hit could these multiplex stocks take if the ruling is against them. However, the first piece on First Word is that the NSE, which wants derivatives trading to continue much beyond the current trading hours. The country's largest equity exchange has proposed a second window for derivatives trade, which will start at around 5 p.m. and go on to 11:55 p.m. All this is, of course, subject to regulatory approvals. The whole story, by the way, on our website, bloombergquint.com. It's a complex well, actually, it's not a complex structure if you're an investor per se, unless you are bothered about the settlement and how it happens, because the second window from 5 to 11:55, the basis of how that window starts off trading would be on the basis of the settlement that's happened between 3:30 to 4. The next day's trade would be on the basis of the settlement that happens in the second trading window. And it's not just open for index, it's open for stocks as well. So the earnings after market hours will kind of lose its relevance because the price discovery will happen in that time from 5 to 11 if indeed earnings have come out post market hours. So that trend as we know it will change substantially. What does this mean for brokerages? We'll ask Devin Choksi because he joins us on the phone line right now. But I would say it does two things. One, somebody made a comment to me early this morning that the work-life balance for somebody who's a trader especially, and not just a trader but an investor, now goes out of the window because stocks would move every single time there is a piece of news out there, and you can't avoid that. So that's one thing. Two, what does it do for brokerage businesses? Maybe not too much, because the belief is that the initial stages, the volumes are there will be thin. But let me not dwell too much on it. Let me get in Devin Choksi of KR Choksi Securities, who joins us on the phone line. Devin, good morning, and thank you so much for taking this early morning call. From our previous conversations, Devin, I know that you are in favor of this move. You believe that this will lead to a lot of good, lot of price discovery as well. But derivative trading for stocks also open. That is about what? Over 170, 180 stocks, which will be traded on real-time basis almost throughout the trading day.
Yeah, Neeraj, good morning. Yes, I think we have to accept the reality that we are in a digital world. We are in a connected world. And in connected world, there is no choice but to accept the reality that we have to remain connected throughout. So I think the market is moving in that direction, which is a good thing. In fact, I think some of the better things are likely to happen because of this. Currently, I think the brokerages, since you mentioned brokerages and I talk about brokerages, currently the brokerages are handling the clearing of trades. According to me, I think with this particular move coming in, the clearing will have to go directly with the custodians, I think, who will be handling this particular subject on behalf of the professional clearing members and then the custodians who will be handling this particular trades and not the brokerages, because I think the market demands security at the same time. So I think this is one positive thing which otherwise brokerage would have never agreed. I think this is now happening by force. So I think this is a good thing happening. Along with that, yes, I think the investors will remain awake till little later in the day, I think, for the stock prices. But I believe that those investors also keep tracking these global markets. And soon you get aligned to the global markets. I think you require our markets also to remain open for that purpose. So I think the time will tell how much we'll adjust ourselves, but I don't see, I think, much negative here, though a little bit hardship in the beginning. But I think at the end of the day, it is going to be positive as it looks like.
Devin, would this be a result of the need to have price discovery, or is this a result of more volumes being desired by the exchanges?
Well, I think one is not the substitute of the other. I think they both are complementary to each other. The discovery of the price and the volume, they happen together. So certainly, I think allowing the market to continue beyond market hours and let the price discovery take place, I think nothing wrong with that part either. And at the same time, in the process, if the exchanges do get the volume out of it, it is better. Though I would agree on one aspect that I think current volume of the exchanges is purely speculative volume. Hardly this volume is on the hedging side, or to be very honest, I think on the managing the portfolios. For that purpose, I think this volume is not there. So to me, I think if you allow this kind of speculation, then it would be disastrous for the market. You should probably, I think, allow the delivery-based trades across the derivative stocks, and that too by removing the conditions like market lots, etc. I think those conditions should be removed particularly. Then the market integrity would be intact even post-market hours.
That's my limited point, right? We're trying to make sure that people get into the long-term mode of investing. And here what you're encouraging is that if I have shares of a security which is in the FNO side, and if the results are bad, I don't have the choice of going out and selling my stock at that point of time. But a trader has the option of going out and going short on that stock in order to make his quick money.
Yes, and you are right, absolutely. I think current system suggests that only traders can operate derivative market. Investors can't, because we have kept the conditions like market lot, etc. This market lot conditions is irrelevant now because we have a digital market and completely digital stocks. Today the stocks are split into one face value and two face values. So I think these conditions were employed somewhere in 2000, early 2000, when this situation was not there. Maybe the exchanges and the regulators will have to think and probably get out of this particular market lot system so that the investors can participate. Even they can head their portfolios when it comes to. Today they cannot. I think the traders only enjoy the market. So I think, yes, you're right. I think this change has to come on.
Well, let's see. I hope all the changes happen simultaneously if they have to happen. Devin Choksi, thank you so much for taking the time out and joining us this early in the morning. Devin, to be fair, has been in favor of this because he firmly believes that this will lead to better price discovery going ahead. A lot of other people that I've spoken to are not in the favor. So, but that's what makes the market. There are enough number of people for and against any particular decision that the regulators might take, be it any regulator or the exchanges for that matter. I must tell you, though, a lot of frown faces early in the morning. However, we'll get to know about this when it actually does happen. For now, moving on to the other pieces. More construction has aided Asian Paints in the first quarter. The paint maker saw its decorative segment post double-digit growth, which helped offset higher raw material prices. Yash Upadhyay is here to take us through the key takeaways from the numbers. Yash, good morning.
Good morning, Neeraj. So their revenues posted a strong 15% growth, coming in at about 5,391 crore rupees on the back of that strong double-digit volume growth that we are speaking about. Now, the management doesn't give us an exact number, but the analysts believe that it would be about a 13% volume growth, which is largely in line with the street expectation and would make it the second consecutive quarter of double-digit volume growth for the company. This in turn has helped their net profits, which have grown by as much as 31% to 558 crore rupees, which is significantly higher than the Bloomberg estimate of 517 crore. This comes despite of the fact that the quarter saw lower other income and higher other expenses. So cost control measures, they have helped their bottom line. Also, the higher input costs, they continue to be a concern. So the management is expecting input cost inflation to continue with prices expected to increase by as much as 10% in the second quarter. But price hikes, they would be restricted following the reduction in the GST rate from 28% to 18%, and that is something which the brokerages believe would be negative in the near term when it comes to their margins. Also, this quarter has seen a secular growth across its business vertical. So the management has given a positive commentary when it comes to the demand condition for both its auto and industrial paint business. They are seeing a strong growth in the powder coating business, and also their home improvement business, which is a small fraction of their overall top line. That, however, has seen a 44% growth in revenues on that low base of last year. Finally, coming to the valuations, well, the stock by no means is cheap. It's trading at about 54 times its one-year blended forward price to earning multiple, which the brokerages believe is something which is extremely expensive. So CLSA, they have, in view of this, downgraded the rating on the stock from buy to outperform, but have raised the target price. They believe that the recent run-up in the stock price of as much as 25% is the main reason forcing this downgrade in rating, while JP Morgan, they maintain a neutral rating. They believe that the demand valuations keep them on the sidelines, but they have raised the target price to 1,400 rupees. Back to you.
Interesting. Thanks for putting that into perspective. Yash, it becomes important to highlight Asian Paints simply because this week has been full of news. Post the GST changes, the last couple of days, Asian Paints has had a good run. 2.5% yesterday, about 1.5% in Monday's session as well. And it's no longer the Asian Paints that was 4 months ago, where Titan was ruling the roost. And in comparison, the Asian Paints valuations were at about 42 times. The valuations have moved up. The prices have moved up without a factor of the earnings being there, and now that the earnings are out, it does become terribly expensive. That is not to say that the stock will correct vehemently, because there is that earnings support that comes in for Asian Paints, but the question of valuations does firmly remain in place. So the likes of Asian Paints, HUL and some of the others continue to stay higher because of the consistent earnings delivery. How much further then can they go up? That remains to be seen. Okay, no such luck for telcos though. Vodafone and Bharti Infratel will kick off the Q1 earnings season for the telecom space. Other operators like Airtel as well as Idea Cellular will all follow in quick succession, and the average revenue per user is expected to only head lower. Amit is here to tell us about that. Amit, we had spoken about this when you were doing that piece on Reliance as well, that ARPUs are expected to go off.
Yes, they are expected to go off. In fact, in the first quarter, there are 3 reasons which will be impacting the earnings of the telecom companies. Now, first is that this is the first quarter where the full impact of the cut in the international termination rate will come in. Second is the pricing action by Jio on the postpaid side. Now, so far the postpaid revenues were not impacted, but because of the new offers that Jio brought in the first quarter of financial year 2019, the postpaid revenues of the telcos will also be impacted in this quarter. Third is the ARPU down trading that the sector saw because of the cheaper discounted plans offered by all the telcos. Now, for Bharti Airtel, their ARPU, that is the average revenue per user, is expected to decline to around 108 rupees. That is 7% lower compared to last quarter, and this could be the lowest ever ARPU reported by the company. Now, for Bharti Airtel, the margins are also expected to decline because of the high energy cost, network cost, and because of losses coming in from the Telenor India consolidation. Interest cost is also expected to be higher because of the forex losses and higher debt. Now, however, for Airtel, for the Africa business of Bharti Airtel, which has been the star for the company, healthy trends are expected with continued revenue and EBITDA growth from the Africa business. Now, for Idea Cellular, their ARPU is expected to decline by around 6% to around 99 rupees in the first quarter of financial year 2019. However, the company's revenue and EBITDA is also expected to decline because of the sale of the tower business, which concluded in the last quarter, and the EBITDA could also additionally be lower because of the one-offs that we had seen in the last quarter, that is the fourth quarter of financial year 2018. Analysts are also expecting the cost to remain high as the company is still into the network upgradation phase, so that could also impact the EBITDA of the company in the first quarter. Now for Reliance Jio also, ARPU is expected to decline to around 127 rupees, and this could be a fall of around 7% for the company. Now this could be because of the no Prime membership fees collected from the old customers and because of the tariff cuts that we had seen in the first quarter. However, revenues on the other hand are expected to rise because of the strong subscriber addition seen by the company in the first quarter. The company added close to 2.9 crore subscribers in the first quarter, and on the back of this, Jio is expected to outperform the overall telecom pack in the first quarter of financial year 2019. Now, key things to watch out for in this earnings would be the capex plan of all the three telecom companies, how they are going to fund it, and what is the leverage ratio that they are comfortable with would be a key thing to watch out for. Along with this, also management commentary on tariff changes and ARPU revival, when they're expecting the ARPUs to revive, will be a key thing to watch out for in this earnings.
Interesting. We'll watch out for all of this, Amit. But one name from the telco-related space comes out with results today, Bharti Infratel. What's expected?
So consolidation in the telecom service provider space is yet again going to impact Bharti Infratel in the first quarter of financial year 2019. Like what happened in the last 2 quarters, in the first quarter also the company is expected to see tenancy exits because of shutdown of telecom operators. Now in financial year 2018, the company lost close to 14,500 tenants on an absolute basis, but of them 2,500 still continue to pay in financial year 2018. So this full impact will be seen in the first quarter of financial year 2019. Rental income is expected to be impacted because of the fewer rollouts by the existing players, while the energy business will see a seasonal dip in the first quarter of financial year 2019. Now if you see the headline numbers, the revenue is expected to decline by around 1.6% to close to 3,600 crore rupees, and this will be the first time in the last 13 quarters where the company will see the revenue decline compared to last quarter. EBITDA is also expected to be down by around 7% to close to 1,500 crore rupees, while margins are expected to contract to 41%, and this could be the lowest ever EBITDA margin reported by the company in the last 18 quarters. Net profit is also expected to be marginally down by around 0.6% to close to 602 crore rupees versus 606 crore rupees reported by the company in the last quarter. Lastly, key things to watch out for in these earnings would be management commentary on further tenancy impact, update on the Indus Tower merger, and their outlook on the tenancy growth in context to Reliance Jio rollouts would be a key thing to watch out for.
We will watch out for this. Amit, thanks for putting this into perspective. The last but not the least, something that may not impact Nifty levels and may not impact really a wide range of stocks, but will be the focal point of all shareholders of Inox and PVR. Cinema hall owners will be waiting today as the Bombay High Court is expected to take up the Maharashtra government's response to proposal to cap food prices at multiplexes in the state. The minister in charge has already made it clear that the administration is in favor of this cap and also allowing outside food to be carried inside a movie theater. Stocks have reacted already. So the question is, what is at stake for some of the country's largest multiplex houses purely from this decision? Saloni is here with that analysis. Saloni, so this is only Maharashtra. We can always go out and on conjecture say that if it's happened in Maharashtra or if it happens in Maharashtra, it could happen elsewhere as well. But let's for now restrict ourselves to the decision that comes out today and the impact that it potentially could have on the multiplex stocks.
So Neeraj, this decision could hurt large multiplex players like PVR and Inox, which operates extensively in the state of Maharashtra. Just to put things into perspective, PVR operates nearly 37 cinemas in Maharashtra, which is 28% of their portfolio in India, while Inox operates 27 properties in the state out of 123 cinemas in India. Now, in terms of revenue breakup, food and beverage segment, that is their F&B segment, contributes a major proportion to their top line. For PVR, it contributes around 27%, while that of Inox is around 23%. So quite an impact on the top line. So that apart, F&B segment is also the second fastest growing revenue stream after advertising for cinema players, and it has grown over 10% on a YOY basis for both the multiplex players that we have seen. F&B remains a high margin business for PVR and Inox, and their gross margin remains over 70% as of FY18. Now moving on to stock performance, as you correctly highlighted, both stocks have actually declined over 15% since the announcement was made to allow outside food in the theater. And lastly, if you see in terms of valuations, PVR trades at a price to earning multiple of 31 times, which is 1/3 as compared to its 5-year average, while Inox trades at a 66% discount to its 5-year average. So overall, if you see, this decision could bring some relief to movie watchers like us. However, on the contrary, multiplex could hurt substantially given their high contribution to F&B segment. Neeraj.
Saloni, by any chance, have any of the analysts that you may have spoken to over the last fortnight or so mentioned that this price correction that we've seen in these stocks takes care of the decision that comes in the state of Maharashtra, at least, if not all over India? Or are they believing that if this decision comes out, even after correcting whatever 30-40%, that these stocks have already corrected, especially Inox, there could be more downside?
So analysts remains bullish on both PVR and Inox despite this move by Maharashtra government, and they are of the belief that the stocks have already somewhere priced in the F&B segment correction that we will be seeing, and they prefer not to comment on their top line and bottom line estimates, and they wait for the final verdict by Bombay High Court today, Neeraj.
Okay. Let's wait and watch. So the numbers are interesting. Saloon, thanks for putting that into perspective. The numbers are interesting. In Maharashtra, PVR derives 28% of its revenues from Maharashtra. Inox derives 22% of its revenues from Maharashtra. More importantly, F&B segment is a higher margin segment, and which is why the fear is that if indeed this ruling comes out in favor or against the multiplex companies, and it gets spread over to the other states as well, the higher margin revenues get impacted, and therefore the profitability might get impacted a lot more than what the revenue impact might be seen. And that's really the worry, and which is why Inox Leisure is currently trading at 200 as opposed to 270, 280 that used to trade at somewhere at the start of the year. A lot of mid-cap stocks have come off, but these ones in particular. And the last thing, I just want to reiterate the plate, which was the last plate in this piece that Saloni brought out, the valuation plate, the PE for FY19. And Inox Leisure's PE tells a story. It's at 18 times. The 5-year average of Inox Leisure is 53 times. That's the extent of damage that has happened to the valuation multiples already. Maybe pricing in some of these losses, and then general, the kind of P multiple destruction that we've seen at the mid-cap space at large. Well, that's all that we have on First Word today, but lots more lined up on the show. A bunch of management that we speak to. Firstly, we discuss markets and macros and the political situation with Ajay Srivastava of Dimensions Corporate Finance. Decode ICICI Prudential Life Insurance earnings with Managing Director NS Kannan. And with HDFC AMC headed to the exchanges, we talk about the growth opportunity for the asset management companies with Amit Jeswani of Stallion Asset Management and Siddhartha Khemka of Motilal Oswal. But after this break, it's all about the day's trade.
Family businesses get a bad rap. Traditionally, they were looked down upon for getting rich any which way possible. Today, they're still looked down upon, but for very different reasons. For not being modern, for being too traditional and not being agile enough. I think it's easy to forget that the Tatas, the Birlas, the Ambanis, the Hindujas started off as humble family businesses. It's the way India has always done business, and it's the same all over the world. Walmart was a kirane ki dukaan once. I'm Sonu Bhasin. I've served as top management and as advisor to top management. I believe I have learned what keeps a good business ticking. Join me in a conversation with the stalwarts of the Indian family businesses, of building a business legacy that spans across generations. The Inheritors, an exclusive event by Bloomberg Quint.
anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Welcome back to Indian Open. Let's see how the Asian markets are faring at this point of time. Most of the Asian markets are doing well in trade. The Nikkei is up 0.5%. The Hong Kong markets are up 0.6%. The Shanghai is absolutely flat. And the SGX Nifty is giving an indication that probably we might head in for opening highs on the Nifty. So 11,172 is something that we need to watch out in trade today. So in most cases, there is a high probability that we might hit a record high on the Nifty itself today. But what are the cues that the F&O system is throwing up? Expiry there tomorrow, Agam. 11,100, is that the support that the market is looking at?
Absolutely, Darshan. That is the mark that the market's looking at. And but let me start off with the rollovers for the Nifty and the Nifty Bank. The Nifty rollover standing at around 36% with 2 sessions to go, largely on average lines, not too much to speak for. It's the same for the Nifty banking futures as well at around 31%. That's where the rollovers stand. Moving in, when we consider the other variables, talking about the most active options, as Darshan mentioned, we are looking at more writing around the 11,100 put, thereby indicating that there just could be some amount of support building in as we move into trade today, considering the SGX Nifty is also indicating 10,000 or rather 11,150 at this point in time. Unwinding seen in the 11,100 call as the Nifty moves up higher. But in terms of other variables, let's pull up the Nifty put call ratio. That is even higher at 1.89. There should be some caution set in only on the back of the Nifty put call ratio, which seems substantially high at this point in time. And of course, the Nifty Bank put call ratio, on the other hand, has actually dipped below the mark of 1. But among others, we're keeping an eye on Adani Power and Adani Enterprises moving back into the F&O ban. And in terms of stocks that we're watching out for, NIT Technologies, rollovers at around 58%. The stock has advanced to new highs and it will just continues to move from strength to strength. Watch out for this one. We're seeing a lot of traction in Arvind as well, where we've seen more addition in its August open interest. Again, fresh longs coming in. And finally, let's pull up something like Kajaria Ceramics. Again, fresh longs, even as we see more traction building in August. So we started to see a lot of more traction in the mid-cap space in comparison to the large-cap space. And we're just going to have to wait and watch whether or not we see that strength come through even as we go into today's day of trade.
Let's wait and watch what happens there. Agam, thanks for putting that into perspective. Well, a lot of things to watch out for because of the expiry news and a lot of things to monitor because of the results that will come out today and the results that have come out post-market hours yesterday as well. Santosh Singh, Head of Research at Haitong Securities, joins us right now on the show with his thoughts on the fundamentals. Santosh, good having you. Thanks so much for joining in.
Thank you.
How's this earnings season shaping up? Maybe just the initial start was maybe slightly weak. I think the consensus on Bloomberg downgraded the Q1 earnings ever so slightly. But most people that I speak to now are working with an assessment of maybe an 18 to a 20% growth in Q1. Is it on course for that?
So till now the results have been good in a way, because whatever results we have looked at, other than the ones which came yesterday, specifically Symphony, which was a disaster. But other than that, mostly the results were in line with the expectations that we are expecting, between 15 to 20% EPS growth for this quarter, for this year itself, because of the lower base which we had last year. Because one of the things which is working clearly is the lower base of GST and DMON, which impacted the last year Q1. So that's where it's in course for that 20%, but we'll have to see if there is a actual recovery that will only be visible by Q3, when the numbers for last year will also have a base.
Okay. We just spoke about Asian Paints at the start of the show. Yeah. What did you make of those numbers? And what do the valuations of Asian Paints now tell you post Q1?
So, yeah. Clearly, the valuations is an area where we can always argue, because valuations have become so expensive that whatever numbers come in, you might say that it's already baked in the price. Because and that's what the case with Asian Paints also, because the results were good, but yeah, the valuations are very expensive now. So to make money from here, it will be difficult actually.
Santosh, what do you make of the disappointment that came in some of the banking numbers? HDFC was HDFC Bank was slightly off. Kotak also managed to disappoint. And a word, if you can, a lot of notes have started coming out on the Ind AS impact on NBFCs. If you have a view on what this means, can you tell for our viewers?
So, see, HDFC, I won't say it was a disappointment. It was 20 rather than 20, it was 18.5. So, okay, I mean, so it was from HDFC sort of standards, yes, it was a disappointment because after so many years, we saw 1% decline in growth in profits. But Kotak, as such, I think it was explained even on the call of Kotak and all, as a strategy, they decided that they will sort of trim down some of the gains on their or duration on their portfolio, and that causes some of the NIM decline. But at the same time, he was also highlighting about SME stress. So definitely that's an area to watch out for, even for Kotak. So Kotak was, you can say, slight bit of disappointment. HDFC, I might not say it was a disappointment. It's just that HDFC standards are so high. But on the Ind AS side, yes, we have just seen the first few numbers, and it clearly shows that the impact is going to be really high, and specifically on the balance sheet rather than P&L, because P&L might smoothen out in next year, but balance sheet we are seeing good amount of cut in net worth. And let's see how RBI wants to handle it, because if RBI says that Ind AS net worth is tier 1, then we are going to see a cut in tier 1, tier 1 of most of the NBFCs. Now let's see how RBI wants to handle it. That's a separate scenario altogether. But yes, we are seeing across the board cut in net worth. That means all these stocks will look expensive after this quarter. Yes, suddenly the P by B ratios, so if there is a 10% cut in tier 1 in net worth, simply the P by B ratios move up that much.
So will you give an adjusted price to book as well? An adjusted price to book?
No, you can't keep on adjusting.
You can't keep on adjusting. Okay, fair call. Lots more to talk about. You mentioned Symphony and a few other numbers as well, but let's talk about numbers. A steady quarter for Hexaware Technologies. The company also raised guidance for the calendar year. Agam Vakil caught up with R. Srikrishna, CEO of the company, and began by asking him the factors behind the guidance raise.
The first and foremost is our existing deal order book. There is a robust order book. It's a combination of orders from new clients that were booked last year and existing clients that happen every quarter. That's mostly what the guidance is based on. There's a little bit dependence on new pipeline, which is pretty strong. Again, it's strong from both existing and new clientele. And finally, we established a fairly good track record of solid execution. So there's a lot of confidence that we will continue to do well.
Right, Mr. Srikrishna, for the last 3 straight quarters, your margins are hanging around the 14% mark. I was going through some analyst reports this morning which suggested some concerns with respect to margins, especially considering margins are used to be about well over the mark of 15%. My question really is, what's played out this quarter and what can we expect going forward, especially when you keep in mind factors like utilization, forex, as well as your own operational efficiencies going forward?
Sure. See, we had a 2%, a little over 2% drop in utilization this quarter. And that was well planned. It was well planned in a quarter where we know we have some other tailwinds and then we can afford to take a lower utilization without impacting margins, which is what we did. Our sequential quarter margin is flattish, slightly up. And we reduce utilization for doing 2 things. It will improve our ability to service our customers better, faster, and aid revenue growth. And second thing it does is in the 2 to 3 quarter time frame, it helps us improve structural cost because we are not doing just-in-time hiring anymore. So what that means for a margin outlook for this year, we've said that our margins will continue to grow in absolute terms in line with revenues, which means profitability will be maintained. But in the longer term, there's a little bit opportunity for both structural cost improvement and increased utilization, which will lead to better margins.
I want to talk a little more about the banking and financial vertical as well, and perhaps from an industry perspective, a lot of your peers are suggesting that well, you know, this particular vertical is turning a corner. That said, for Hexaware Technologies, it's been relatively stronger as compared to other players in the industry. My question to you with respect to banking and financial vertical is that what are you reading now at this point in time? And if the industry is looking at turning a corner, can we expect even more strength to come through over the next, say, 4 or 5 odd quarters when it comes to Hexaware?
So I think, you know, for us, how we, what segments of the industry we are present in may not be typical of the broader industry. So we have presence in capital markets, we have presence in secondary mortgage, and we are a challenger in banks, in retail and commercial banks. Retail and commercial banks has been the area of, you know, slow growth for a lot of the rest of the industry. We are not an incumbent in that area, which puts us in a good spot. So we don't have the pressures of reducing revenues due to automation. On the contrary, we have an opportunity to gain market share because we are a non-incumbent and we are a challenger. That's on the banking side. On capital markets and mortgage, those two markets have been quite strong for us, and frankly, the buy-side asset managers have been strong for pretty much everyone else who's strong in that industry as well. And we expect that to continue to remain strong for us.
Okay, that was the management of Hexaware, but lots of numbers came out after market hours yesterday. Lots of numbers that will come out today. So we will talk to our research team in terms of which were the strong numbers and which were the weak numbers. Symphony, for one, definitely features among the weak numbers. So we'll start asking our research team here. Shraddha and Saloni join me. Saloni, the weak numbers first. Obviously, I spoke about Symphony. Which are the weak numbers?
So first up on my list is ICICI Prudential Life Insurance. It reported a mixed set of numbers. We have seen an uptick in their new business as well as renewal premium segment. However, the net profit has seen a sharp cut of almost 30% in the quarter went by. Despite steady persistency ratio across all periods, we have seen a drop in their market share from 15% to 11% on a YOY basis. Well, moving on to Symphony, it reported weak set of numbers. Its revenues were down 23%, while net profit was down close to 50%. EBITDA too was under pressure and was down about 40%, while margins contracted by a good 300 basis point. So we may see some negative reaction here. And last on my list is Rane Brake Lining. The company too reported weak set of numbers yesterday, wherein top line dropped over 20%, bottom line dropped by nearly 10% to 7 crore for Q1 FY19, and margins contracted by 3% points to 12%. And all these stocks may react negatively in trade today.
Okay, Symphony is the big one, but a lot of good numbers came out after market hours. Shraddha, among the lots of numbers that came out, which ones are you selected?
So I'm going to talk a lot more about the smaller mid-cap names actually. Teamly Services is the first one. Revenue growth of nearly 20%, net profit growth of 33%, sorry, and EBITDA growth of a much sharper 55%. You have Borosil Glassworks, revenue growth of 44%, net profit more than doubled to 11 crores, whereas EBITDA margins rose 350 basis points to 9.5%. So you might see some positive reaction there. Music Broadcast, you saw a single-digit revenue growth for this one, but net profit grew by 25%, and EBITDA margins also saw an uptick from 31.6 to 34.5%. Additionally, they've also announced a buyback. They fixed the buyback price at 385. So let's see how that one reacts. KSB Pumps, revenue growth of 20%, net profit growth of 40%, and EBITDA growth of 20% in line with the top line growth. So net profit has grown at a faster pace than the operating profit. In our Agarwal Industries is another one. Revenue growth of 20%, net profit growth of 35%, and EBITDA margins expansion of more than 350 basis points to 15.5%. So all of these are likely to see positive reaction. There's also a Mint report which says that Barbecue Nation has raised 80 to 90 crores in pre-IPO funding from Rakesh Jhunjhunwala backed Alchemy Capital. So the promoter of this company is Sayaji Hospital. So Darshan, that could be in focus as well.
Okay, so those are the stocks that we'll watch out for. And an important number that will come out today will be L&T. What are we expecting? We're seeing close close to a 13% top line growth, close to 27,000 crores of top line will come in, a 40% increase on the bottom line, and EBITDA increase of almost 25%, which means that EBITDA margins will come in close to the 9.5% mark. On the exchanges, they've already given orders worth anywhere between 30 to 35,000 crores. We are anticipating that the order inflow for this quarter will be in excess of 40,000 crores. The guidance has already been given. They've said in terms of 12 to 15% for the top line and 10 to 12% for the order inflow guidance. Basically, execution was rather strong. No major disruptions for L&T this time around. So the infra segment will see a lot of traction this time around. As far as the other income is concerned, that's expected to be higher. They've sold in some assets this time around, which could fetch them significant amount of higher revenues, higher amounts. And finally, margins may slightly be weak compared to what was expected because commodity prices have actually risen significantly. So that's what we are watching out for L&T. The management commentary always is the most important on what they expect the outlook to be. But Santosh, any word on L&T? What kind of numbers are you expecting?
So, see, L&T, the only number we try to look at is the order book because everything else is on the back end and the margin. So, what our expectations would be that the margin should expand this quarter and we should see a healthy order book given the sort of expenditure we are seeing on the infra side. We should see a healthy order book. So, the expectations are high here and after many quarters on this stock.
Interesting. I want to do a detailed chat with Santosh on Symphony, so we'll do that in just moments from now. But it's 8:45, that time of the show when we get in our technical experts on board and try and figure out what to do. In today's session, two men who track derivatives very, very closely ahead of expiry. Very important to get in their views. Gaurav Bissa of LKP Securities, as well as Chandan Taparia from Motilal Oswal. Gentlemen, both of you, very good morning. Many thanks for joining in. Gaurav, how are you approaching trade? We might start off marginally higher today. Considering it is expiry tomorrow, PCR at such high levels, what should an average trading position be on the indices?
Good morning. There are a couple of things that one should keep in mind. One, we have seen a small breakout sort of coming in. Nifty has been hovering around 11,000 odd mark, and we have seen some pressure coming on these levels. Now we have given a comfortable close above these levels. If these levels are to be held, 11,200, 11,220 cannot be ruled out. Second, yes, the PCR is on the higher side, but one needs to remember that we are now just a couple of days to expiry, and it's not uncommon that we see some aggressive positions being built for people who have a strong view. So right now we have seen, since there's a breakout, we are seeing good amount of writing happening in the out of the money put options, and that again is a positive sign even though the PCI is on the higher side. So I think any decline towards 11,000 or a little bit below would be a lucrative price point to build fresh long positions in Nifty for targets of 11,200. If somebody wants to play by option, then I think Bank Nifty is the one. It has been underperforming Nifty in last few trading sessions. It has given a breakout. It's not falling a bit, but it has not participated that much. 27,000 call option command, a good amount of concentration. If we are to trade about 27,000 mark, there's a possibility we may see a 300 or 350 point rally coming by expiry. So buying a call option would make more sense in Bank Nifty. As far as Nifty is concerned, I would be more biased in buying on declines in the futures segment.
Chandan, what are your thoughts?
Yeah, very good morning. Nifty has finally given a consolidation breakout of last 8-9 trading session. It was hovering in between 10,923 to 11,078, and in last two trading session it has surpassed the hurdle and holding well, and now it's just few points away from its lifetime high. Looking at the options database, we have seen fresh put writing at 11,100 strike. Maximum put open interest also shifted higher. Call writing has moved to 11,200. So fresh put writing even at 11,100 indicates that participants are not expecting market to settle below 11,050 or so kind of level. We have seen decline in the volatility index, and VIX is again back to 12.5 levels. So overall, the price sentiment as well as the derivatives data setup indicates that positive momentum is likely to be there, and there are a high probability that market is likely to expire even at new high territory. So that's why continue to be with positive sentiment. We'll suggest to buy with keeping a stop loss of previous hurdle zone of 11,080 and expecting Nifty to head towards 11,200 to 11,220 kind of level. Looking at the Bank Nifty index as well, as Gaurav mentioned that it has been underperforming. It has been underperforming because couple of heavyweights names are subdued, got stuck in a range because of the call writing activities. Bank Nifty has seen the put writing and call writing both at 27,000 strike. So expecting Bank Nifty to expire 150 points here and there from 27,000 zone. Nifty is up by around 5% in the entire series, while Bank Nifty is up by around 2.5%. So supports are visible, but underperformance seen. So if holds about 27,000, we'll take a positive stance for 165 points to take a move towards 27,165 in the Bank Nifty index.
What about specific stocks? Gaurav, your stock recommendations for the morning?
The first recommendation today would be buy on Axis Bank. This is one name that has been seeing a lot of pressure at levels of 540, 545 zone. A lot of writing that was seen in 540 call option. For last 2 or 3 series, at least 540 commanded the highest concentration in the entire option chain. And now we have given a close finally above levels of 540, 545. There's a breakout sort of that's also been seen getting built. Decent amount of O addition has been seen. This is I'm taking consideration the rollovers portion as well. Net there has been a long addition on a considerable amount. Now, if the current level is sustained, there can be a small reversal that one can expect in Axis Bank. It can even head towards level of 600. That would be a slightly positional target probably for a month or so. But for immediate basis, one can buy here, have a stop loss of 540, and on the upside targets of 560, 565 can be seen in a day or two. Second recommendation today would be a buy call on BEL. It's more of a short covering rally. We have seen from 100 levels, there's a good amount of short covering that has been seen. If the current level is sustained, there's a possibility it may test levels of 110. Good amount of writing is seen, 1110 call option. If that is also taken out, it can be a good expiry bet candidate that it can move a strong up move. One can have a small stop loss of 105.5 and buy for immediate targets of 110. If that is sustained, 115, 118 in the current expiry itself cannot be ruled out.
Okay, and Chandan, your picks?
Yes, I have selected 2 stocks. One is the LIC Housing Finance, second is the Infosys. First, talking about LIC Housing Finance, the stock has given a fresh breakout, surpasses falling supply trend line, given a decisive close over 520-22 zone. So positive momentum could continue. It also formed an inverse head and shoulder pattern, which has a bullish implication. And most of the NBFC stocks started to getting attraction with built up of long position as the put writing activity. So LIC Housing Finance is buy with a stop loss of 525, and it can move towards 560 kind of level. Second trade we have selected to be with Infosys, that is heavyweights. The stock has the highest daily close and decisive hold above 1355, 1375 zone. We have seen a price volume breakout and retest of the support with put writing activity. So positive momentum could continue to cheer the broader market as well. So recommending to buy with a stop loss of 1355 and expecting this heavyweight to move towards 1410 to 1417 kind of level.
Okay, on to our special segment, Bloomberg Edge, wherein Jayesh Khilnani tells us about a pattern that the Bloomberg terminal has thrown up on a stock. Jayesh, what's the stock on your radar today?
Morning, Neeraj. It's one of the stocks that Chandan also spoke about. In fact, it's Infosys, and for good reason as well, because last couple of days, while the Nifty IT index has been declining, this stock has in fact gained 2.5%, and with yesterday's close, it managed to close above the trend line, which means that there could be a buy signal on the cards and further upside for Infosys as well. First, let's have a look at the trender indicator and how it actually works. It's a proprietary Bloomberg indicator which uses the average true range as one of the key inputs for calculation. Not only does it help you to generate buy and sell signals, but also tells you where the stop loss should be placed. And it's very simple to interpret because you have to follow the color of the indicator. So you buy when the trender flips from red to green, and you sell when the trender flips from green to red. Let's have a look at the chart of Infosys and how it looks like. That's the last 6 months, and you can see that it had in fact reached the 1350 levels, post which it declined and formed a U-shaped pattern, and now it has once again crossed above that level. The red line, which is the trender line, that was actually the resistance line that was pointed out. But yesterday's close, you can see this candle has in fact managed to close above the red line, which means that there is a buy signal on the cards.
Okay, and if you backtest this, Jayesh, what's the average return that this indicator has given?
So Darshan, in the last 1 year, if you had bought all the indications given by this, the return would have been close to 17%.
Okay, so that's the view that's coming in on Infosys. We'll certainly watch out for Infosys. But Santosh, one important number that came overnight was ICICI Prudential Life Insurance. Not the best of numbers recently, but what do you make of the numbers?
Yeah, so I said that there is, because with life insurance, Q1 is always a confusing quarter. because your new businesses are very low. It's a small fraction of what happens in the full year. And it depends on the company how they want to charge the expense. So if they charge the expense upfront, which was the case of ICICI, where last year they decided that advertising will be back-ended rather than front-ended. This year advertising was a big expense this quarter itself. So what happens is, in that scenario, your statutory profit falls. But if you're doing the right business because of that advertising, your new business profits increase. So from a shareholder's perspective, what is important is that, see, advertising is like an investment. So it's like a capex for the company. And then what it turns out to be is a revenue item, which is the new business profit. So eventually the new business profit turned out to be growth of 36%. Whereas the statutory profit fell. And in my opinion, by the end of the year, you might not see a fall in the statutory profit also, because what happens is the premiums catch over the next quarters, whereas the expenses don't increase. So by Q4, you might find that, okay, fine, the profits might not, in our opinion, it might not grow by 8-10%, it might be 5 to 6% growth in profits. But by the end of the year, even the statutory profits might grow by 5 to 6%. Whereas new business profit growth means that the shareholder value is being created. So shareholder value has increased by 35-36%. So it doesn't make it for a bad number. And new business premium this quarter was down because last year it was a demon quarter wherein the premiums increased by 45-50% for this company. So this year it was definitely bound to fall. But what you will find is the reversal will happen by Q4, because Q4 last year was weak, this year it will be strong. So I don't think it was a bad number. It was not great. HDFC was, I would say, a great number, but it was a good number yourself.
Okay. Very interesting. So what's the pecking order in the life insurance space currently? I mean, I remember last time you probably were most bullish on ICICI Prudential on valuation front, no?
HDFC, Max, ICICI and SBI, that has been our pecking order for very long time.
And it stays that way?
It stays that way.
HDFC and Max as the top two players?
Yes.
Okay, interesting. A number that you spoke about, Symphony. What did you make of the quarter? More importantly, Santosh, what did you make of the commentary that seemed a bit worrying when asked by an analyst about whether they can confidently guide to a double-digit growth in the core India business this year? The management did not say that, reply to that in the affirmative.
Yeah, so Symphony was a big disappointment for us also, because that's a buy call we have on the stock. So it was a big disappointment for us also, because cooler was one segment where we were bullish on. And clearly this quarter numbers were, not only the quarter numbers were bad, as you pointed out, even the guidance was not very clear on what sort of growth, what sort of number we are expecting. And even margin decline was another set of disappointment, because one is the top line, another is the margin part. Even margin decline was some sort of disappointment. So we were expecting at least growth and margin expansion over the next 2-3 years. So clearly it was a disappointment, and so I would not say any other thing about it.
No, so no, the question is, Santosh, one is the stock prices could move up or down, because one is the earnings move up or the P multiple moves up, and consequently the earnings and the multiples move down. In this case, do you think both will happen over the course of the next couple of quarters?
See, if next quarter is also like this,
they've guided to that, right? They said that the next couple of quarters will be weak.
So both can definitely happen, because it's not a cheap stock. It's trading at in excess of 33, 34 times earnings. So it's not a cheap stock. And for the stock, so means of that thing, if 2 or 3 quarters are disappointment, then definitely the re-rating happens both ways.
Okay, that's a clear and present danger for Symphony, so do watch out for that as well. Correction has happened already from last quarter to this quarter. There is no saying that there couldn't be more in store. Just one quick thought, Santosh, on the cement pack as well. Yesterday was the blockbuster performer. Today Ambuja comes out with numbers as well. If Ambuja's realizations as well match up to the commentary from Ultratech and 2 the performance from ACC, would you turn constructive on this pocket, assuming that you were not constructive earlier?
So your assumption is right, we were not constructive earlier. So yeah, means definitely if it happens that way, we need to, because again, the analyst needs to go back and see what he has baked in and what the numbers come out. I can't say that we will turn constructive, we can't say turn constructive, but yes, if the numbers are like that, then definitely we will have to go back and see what we are baking in the numbers.
Okay, a word on the two-wheeler space, most of them trading near lows. Do you think that Bajaj Autos played down this, price war thing, but the market doesn't seem to be believing that? What do you make of this entire scenario now? Is this price war here to stay?
See, Bajaj Auto was very clear in saying that they are going to do whatever they need to do to get market share. Now, if that's the case, then definitely there is a price war, there will be a margin problem. And none of the players in this market can say that if one goes for a price war, other will not have to cut prices. So clearly, our view is that this is definitely negative. And we yesterday also we in a note said that actually in this sort of environment, one should avoid two-wheeler space unless and until there is a clarity in where the market settles on the pricing side. Because these sort of wars when turns out to be sometimes nasty. So we need to wait and watch on this rather than get into it. So we are saying avoid on the two-wheeler space as of now.
Okay. Gaurav, Bissa, quick 20-second view. We're just very close to pre-open. Would you initiate any kind of trades on Bajaj or Hero?
Bajaj Auto is trading near the 7-year channel support if it's of 2650. Any close below this would open gates for at least levels of 23 and 2350. So I would give it some more time. A weekly close below 2650 would be a short candidate. Otherwise, if it gives a close about 2700 levels, then with a stop loss of 50-60 rupees, one can buy for targets of 2900.
Okay. Stay on, gentlemen. So much more to talk about. The pre-open rates about to kick in. Let's bring up what the rest of the world is doing as well. Asia seems to be a mixed bag with some bit of positive buyers. Nikkei is up about 0.5%. Hang Seng about 0.75%. The SGX Nifty is indicating a flattish start, but this could be deceptive. Let's wait and watch. More importantly, the broader market strength might be a factor in today's session as well. FIs have been net buying in Indian markets for the last 3 or 4 sessions, so that's a positive move too. And the pre-open session, these are all-time highs, but let's wait and watch. Let the pre-open rate settle down and we'll get an indication of whether we're above that mark of 11171 or 11172 as the case may be. Let's wait and watch. Right now hovering around that mark. The Sensex about 111 points. Let's give these rates a chance to settle. Bring up Asian Paints and bring up Symphony, two names which should ideally be reactive to their numbers, and then a clutch of others. But Asian Paints, well, all over the place. Maybe a positive start. I wouldn't be surprised with a shocker on Symphony. Well, that's a 20% downtake. It may not be a 20% downtake, but you never know. As Santosh was saying, it's an expensive stock and the numbers were a howler. The guidance wasn't the prettiest. So we'll probably have some downtakes coming in on Symphony this morning. Whether it's a 20% or a 10% remains to be seen. But we'll start off on a negative note. What else? Just before I hand it over to Darshan, just want to mark the currency and the bond yields as well. Just bring those up. It's a flattish start, I believe, for the rupee. No great changes there. The bond yields too at about 7.8 or 7.81, 7.78. Yeah, so no big changes out there on the bond yields either. But what Symphony's done could probably weigh in on the cooling solution space at large. That's the one big howler, Darshan. What else are you spotting?
Yeah, so Hexaware is down 10%. That was the other number that came out. Mixed set of numbers. The pre-open rate is indicating a 10% downtick that's come in. 8K miles continues to bleed in further. Let's take a look at some of the numbers that came out after market hours. Asian Paints, let's pull that up again to see whether it's reacting positively or no. It's up almost 4%. Teamlease came out with strong set of numbers. So let's pull up Teamlease. Let's pull up Borosil Glass. That came out with very strong set of numbers. There was a music broadcast that came out with strong set of numbers. KSB Pumps and NR Agarwal Industries. So these were the strong numbers that came out in trade overnight. Let's pull up Hexaware again. It was a mixed set of numbers. Whether it is still continuing, it still continues to wane. And among the weak numbers, ICICI Pru Life, there was Rane Break and Symphony. Let's pull these three up again. ICICI Prudential starts lower, down 4%. Rane Break lining, let's pull that up. It's not open. And Symphony is the last one that we want to pull out. And Symphony has managed to recover smartly from the lows of the day. So it'll be interesting to see that, Neeraj.
Yeah, no, Darshan, you put it right. It'll be interesting to see what Symphony does. The only thing that goes in favor of this stock, to my mind, is one, the correction that we've already seen in the stock from the last quarter to this quarter, and the fact that their Australian business kicks in from this quarter, and the Australian summer coincides with the Indian winter, and therefore the disappointment in the core Indian business might be partly offset by what happens in the Australian business if they manage to give it enough leg. But it may not be down 20%, but I really doubt. I mean, I'll be really surprised if Symphony has a flattish start to the trade today. The guidance was wobbly, and that should have some bit of bearing. As Santosh said, the valuations are not cheap at all. So let's wait and watch what happens there. Just one last thought on cement names. Just bring up ACC and the whole category because it was extremely buoyant in trade yesterday. And let's see if that buoyancy continues. Everything from an ACC to a Dalmia Bharat to a Sanghi to an Ultratech did very well. So it was not just the large caps, the mid cap cement names and the small cap cement names too did very well. It'll be important for bulls in that space to see some more traction out there. Let's wait and watch if that happens or not.
The two-wheelers are reacting. Bajaj Auto is up 3.5%.
Up 3.5%.
And Hero is up 2% in pre-open. So I think after the big sell-off, we're seeing a little bit of buying come back in the two-wheeler names.
Yeah, at 52-week lows, maybe there's some bit of buying that is out there. Last but not the least, ICICI Prudential. Maybe the market is still not being able to read this correctly, but it's likely to start off about 3 or 4% lower. And Radico Khaitan, after yesterday's blockbuster move, likely to start off another 5% higher. So let's wait and watch for that. However, before we talk about some more stocks, let's talk about the primary markets. It's the largest equity-oriented asset management company in India, which is coming out with its initial public offering. HDFC AMC is all set to be listed on the bourses. The IPO will open for subscription today. But before that, Amit Sarkar is here to tell us all that the company has to offer and its public offer as well. Amit, good morning yet again.
Good morning, Neeraj. If you see, the asset management company is looking to reach close to 2,800 crore rupees at a price band of 1,095 to 1,100. And at the upper end of the price band, that is 1,100 rupees, the company will be valued at close to 23,300 crore rupees. Now, the IPO is a complete offer for sale where both the promoters, that is HDFC and Standard Life, will be selling their shares and gaining close to 56 to 73 times their investment in the company. Now, if you see, HDFC AMC is the largest asset management company in India in terms of equity-oriented asset under management, and the second largest asset management company when it comes to the total overall AUM of the company. Now, if you see, it could be also the second listed asset management company in India. Now, over FY14 to FY18, the company's total asset under management has increased at a compounded annual growth rate of 27.5%, and as of June 30th, 2018, the company's total AUM was close to 3,07,600 crore rupees. Now, the company has nearly 133 schemes, of which 27 are equity oriented while 98 are debt oriented. Now, if you see, of the total mutual fund AUM, 47% is related to equity schemes while 38% is related to debt scheme. And over FY15 to FY18, the proportion of equity schemes contribution has increased to 47%, which works in favor of the asset management company as it is a high margin business for them. Now, on financial comparison, if you see, I've compared it with Reliance Nippon AMC and ICICI Prudential AMC. Now, Reliance Nippon is the only listed asset management company in India, while ICICI Prudential AMC is the largest asset management company in India. Now, the growth rate for HDFC AMC has been better than the listed peer, that is Reliance, but it has lagged the growth rate of ICICI Pru. Now, the company's revenue, net profit and AUM over FY14 to FY18 has grown at a compounded annual growth rate of 20%, 19% and 27.5%. And if you see the unit metrics, HDFC AMC's net profit as a percentage of AUM, now that is highest when compared to its peers, and that is the reason why it is the most profitable asset management company in India, and this is because of its higher revenue and expense metrics. But over FY14 to FY18, if you see, all the three unit metrics, that is revenue, net profit and total expense as a percentage of AUM, have declined for the company. On the return ratio side, the company's return on equity and return on asset are better than Reliance Nippon, but it is lower compared to ICICI Prudential AMC. For financial year 2018, the return on equity stood at around 33.4% and return on asset at 36.4%. Also compared to last year, that is financial year 2017, the return on equity for HDFC AMC has declined to 33.4%. On the valuation side, if you see, compared to Reliance Nippon, which is the only listed AMC in India, the valuations are pretty expensive. The price to earnings is at a premium of 19%, and for financial year 2018 it stood at 32.3 times. Price to book is 10.8 times, and market cap as a percentage of AUM is double to that of Reliance Nippon AMC, and it's for FY18 it was close to 7.8 times. Lastly, on the brokerage side, all the brokerages have a subscribe rating on this IPO. Motilal Oswal has a subscribe rating on the back of the HDFC brand and because of the higher mix of high margin equity oriented scheme. Angel Broking has a subscribe rating because of the high growth potential of the mutual fund industry, strong return ratio, its asset-light business model, and a higher dividend payout. While Choice Broking has a subscribe rating despite the expensive valuation, as it says that the expensive valuation is justified on the back of the higher concentration of the equity assets, most profitable AMC tag, and because of the HDFC brand.
Well, thanks a lot for that, Amit. So that's the HDFC AMC IPO in complete detail. Santosh, you want to dwell in on this a bit? What does this mean for somebody who wants to invest in the HDFC AMC IPO? The premium, grey market premium, seems to suggest that you will make money. But if it does manage to do that, what's the valuation that it trades at? And therefore, is it a good hold even after subscribing?
Yeah, so the reasons why we will buy HDFC AMC is definitely HDFC brand, distribution, and finally, I would say even the valuations, because one of the things which we saw is it's trading at a huge premium to Reliance. It's not that way, because when we saw Reliance number, the pension assets are included there. On a mutual fund to mutual fund basis, Reliance is also trading at 5.5 sort of as a percentage of AUM. This is coming at around 7.5. But that's the sort of expectation you will build in when you are sort of buying HDFC, because all the HDFC companies, if you look at, they trade at that sort of premium to most of their peers. And that's mainly because of the right reasons, also because over a longer period of time, the growth rates are much more normalized in HDFC than most of the other companies. So clearly, it's trading at 21 times FY20. That's our numbers for FY20, which we use for HDFC Limited valuations. It's trading at around 21 times earnings. And if I compare it with the global peers for a 15% growth rate, it's actually in line with the global peers. So this is one industry where the IPO is coming in line with the global peers. Most of the time we see that the valuations are 30–40% premium to the global peers. So that's where I think valuation, branding, distribution, this is what makes for a good IPO.
Okay. So we'll watch out how the subscription numbers come, but we're just minutes away from the market opening, and we'll tell you all that you need to know to stay ahead in today's race. First of Bharti Infratel, Hero MotoCorp, L&T, Ambuja Cements, IRB and JSW Steel are the companies that will report their numbers today.
Among companies that reported results post-market hours yesterday, Asian Paints, Team Lease, Borosil Glassworks, KSB Pumps and NR Agarwal Industries reported a strong quarter.
On the other hand, weak numbers from Rane Brake Lining, Symphony and ICICI Prudential. All three companies are down. Symphony is down 14% now.
Shifting focus to primary markets, HDFC Asset Management Company's IPO opens today for subscription. Price band set between 1,095 to 1,100 per share.
And in cues from the derivative space, Adani Enterprises comes back into the FNO band. It's the only stock in the band.
In brokerage calls, SBI Capital downgrades Hexaware to a sell. Meanwhile, CLSA downgrades Asian Paints to outperform, both the stocks starting off in the negative. Well, that's something that you got to keep at the back of your mind. Hexaware is an interesting one. Chandan, Taparia, I don't know if you guys track Hexaware for a trade. It's starting off 6% lower. Any thoughts here?
Looking at the IT counter, however, some sort of consolidation is clearly visible. Hexaware couple of days back had a strong run-up, then has been consolidating, and the stock has nature after falling down from higher levels and then turning higher. So my suggestion is let it come down, let it go to 450, 455 kind of zone. Near to that, it will again give the buying opportunity for an up move towards 475 to 485 kind of levels.
Okay, Gaurav, I believe you were speaking about the mid-cap index. What do you make of the mid-caps on the index or the stocks? Anything that looks interesting, because most of them have been rallying off late?
Well, mid-cap index is looking quite interesting, and we have also advised to our clients on the index itself that it has bounced back from the 2-year, 3-year support trend line. It has bounced from the 100 DMA levels, 100 weekly moving average levels, on the verge of a strong breakout of the current levels of 18,500. If these are sustained, if we have a weekly close above these levels, then it can head towards the level of 19,200 to 20,000 mark. And the kind of underperformance we have been talking about, the Nifty is trading at higher levels and mid-caps have been languishing. I think that underperformance will get reduced and we can see a ferocious up move coming in the names. The likes, if we are talking of names, then Arvind has given a strong breakout at 430. One can have a stop at 415 on the upside. 460, 465 can be seen. Among the NBFC, Manappuram Finance is looking quite interesting, can go towards the level of 115. One can keep a stop loss of 98. Ashok Leland among the auto names, if it sustains 113 levels, then it can move towards levels 125, stop loss of 110. Among the non-FNO names, AB Capital is looking quite strong. from the day of listing on a weekly chart is following a downward sloping channel on the verge of a breakout. Has not given a breakout yet, but if the levels of 140 are sustained, a small reversal in AB capital cannot be ruled out. One can expect 15-20% coming in the near.
Hold on, guys. Santosh, before we let you go, what are you recommending clients? Anything stock specific that you are telling your clients now?
Yeah, so I would say that there is one small cap actually which we are quite bullish on.
Okay.
And that's Tejas Network. In this market, talking about small caps, so yeah, so Tejas Network we are quite bullish on because see, we believe on the overall story of broadband data and Tejas Network's ability to sort of work in that market. Last 2 quarters were slightly wobbly for Tejas Network. That means that the stock has fallen quite a lot. Now, what we have been pointing out is that there is a lot of sort of, because the business is a lot institutional, and that means that there will be quarters where the numbers will be down significantly, and there will be quarters it will be up quite a lot. But over a 2 to 3 year basis, we are talking about 25-27% sort of EPS growth in this company. And the valuations, because of the fall in the stock, the valuations are not expensive.
Okay.
So this is one which we like a lot as of now.
Okay. Great. Santosh, thanks so much for taking the time out and being with us today. I really appreciate your time and look forward to have you more often. Well, that's a lot of very interesting thoughts from Santosh. Let's talk about the top call from our experts today. Chandan, Taparia, your top call for the morning.
Yeah, already discussed about LIC Housing Finance and Infosys and expecting these stocks to continue their positive momentum.
So LIC Housing Finance and Infosys, Chandan is giving to Gaurav. If you were to restrict yourself to one top call today, which one would that be?
It will be Axis. Given a strong breakout with a stop loss of 540, one can buy for 565 kind of levels in a day or two.
Okay, 565 odd levels on Axis Bank from Gaurav Bissa. Jaman, if you can stay on, we'll just take in an opening thought from you, post-market open, and here's the market open. We'll start off, well, not at highs, 11,145, so still about 25 or 27 odd points shy of the all-time highs for the Nifty. It's a very flat start for all the key indices. I doubt that the mid-caps and the small caps would be doing something dramatically different. Just about 0.25%, so a bit muted compared to yesterday. But let's wait and watch what the day brings up for us. The heat map should come up on your screen, though I believe the larger action is beyond the Nifty. Asian Paints start off about a 2.5% lower, and OMCs start off weak. What's doing well, if anything, commodities continue to rise and shine. So Hindalco and Vedanta and Tata Steel. Vedanta and Hindalco for the third day on a trot now. Some fairly good gains out there, but beyond that, there isn't too much that is there on the indices per se. Asian Paints, I think, let's bring up Asian Paints individually on the screen, and just a couple of stocks that I want to highlight before I hand it over to Darshan. First, Asian Paints down about 2 percentage points. Symphony, I believe, would be down 12, 13, 14%. 18% cut for Symphony. This is heading close to the 20% lower circuit. 1145. This is an earnings downgrade and a P multiple downgrade as well. So that's the key thing. 19% now for Symphony and continuing to fall. I believe the volumes would be high as well. And Hexaware is the other weak spot today. Let's wait and watch what's happened there. About 7% off for Hexaware too in the session today. Pales in comparison to Symphony, but this is a deep gash for Hexaware as well. Darshan, what are you spotting?
Yeah, so basically on the gaining side, Alchem Labs, yesterday after the 7% move, it's up another 5% because of the EIR for the Daman plant. It's a very big plant and people were anticipating a probably warning letter. That hasn't happened. It's positive for the counter. Radico continues its good move. After a while, we're seeing Dilip Buildcon move in much higher in trade today. Among the losing end, you have 8K Miles, which is down in trade. BSE is down 4% in trade, and the rail companies have given up their gains. So Texmaco Rail is down in trade. Some counters I want to point out: India Bulls Ventures trading at new record highs. Bandhan Bank trading at new record highs. Borosil Glass is trading at new record highs. So that's a significant amount of traction. Symphony almost on lower circuit, will hit the lower circuit anytime now. It was down almost it was down almost 19% at one point of time. And in terms of the Bajaj Twins, pull up the Bajaj Twins. Bajaj Finance, I believe, is trading down in today's trade after a week ago. It's managed to recover. So that's the cue that we are getting in as of now, Neeraj.
Okay, just quick opening thoughts from both Chandan and Gaurav. Chandan, quick thoughts before we thank you. Anything that pops up on your screen? The market has started off flat.
Yes, it started on flattish note, and what I believe after a small dip again buying interest could emerge. So we'll continue to be with our buy on decline strategy. 11,080 is the major support. Till it respect, I think market will again attempt to hit the new lifetime high of 11,171.
Okay. Gaurav, what about you? Opening thoughts?
Market has opened on a positive note. I think these are good enough levels. One can play with the option because market has not corrected a bit. You cannot buy on declines. But yes, Bank Nifty 27,200 call option, I think that is looking quite interesting. One can buy it. Any dip towards 45 rupees would be lucrative buy. Stop loss of 25. Target double can be expected.
Okay. Gentlemen, both of you, thank you so much for taking the time out and being with us this early morning and giving us your thoughts. Well, let's get in a special voice. Ajay Srivastava, he's Managing Director at Dimensions Corporate Finance, joins us right now on the show. Ajay, good having you. Been a while, but thanks so much for joining in. What's been worrying you? Is it the global fears? Is it what's happening within the country on a social level, which might also have an impact on the market sentiment? Or is it that earnings, while they started off well, have shown some chinks in the armor in select pockets?
I think in terms of worry, I don't think, we use the word worry too much, because I think what we use the worry word is caution. And I think the caution is very evident that there is a specific set of stocks which have done well. If including IT, there's only 1 out of 3 which did well. In consumer space, you're seeing well. But the caution is that the big guys, they are the one which are having trouble. When I say big guys on a day like today, if you're talking a little bit negative, is if you look at what's happened to the two-wheeler industry, if you look at what happened to the bellwether banks, they have never reported numbers of this kind ever. This is perhaps the shallowest growth rate they have reported in the history of 2 of the bigger banks, the HDFC and the Kotak. So that segment, the two-wheeler segment, both are giving out red lights and caution. There are, of course, re-rating stories like Reliance, etc., which give you confidence that things are going to do well. There is a pocket called Bajaj Twins, which has done exceedingly well in performance. So what you're seeing is really caution is skewed performance across companies. It's not that the market in unison is going great. It's very skewed performance of maybe 15-20% of the companies, and they are gaining the traction. So you got to be very careful in this market. This market is not re-rating itself. This market is picking up winning and losers, and then saying stay with us as the winners. If you still want to value pick with losers, I think this market will penalize you much further than what you've already been penalized in the last 1 year. So that's the only spirit. Rest good for the market. I think it's become a relief for all investors. It's recovered a little bit, but I still believe that it's caution for non-performers, because value picking non-performers could be the most dangerous part of the strategy in the next 6 to 9 months.
Ajay, hi, good morning. This is Darshan here. Are you cautious about the valuations that,
Good morning.
Good morning. Certain stocks are quoting because the counters that seem to be moving up are high value, they're trading at new highs, while the low valuation stocks still continue to plummet. You have the Bajaj Twins, you have Asian Paints, all these counters trading at record highs, TCS trading at record highs. So it's a select few stocks that are helping the Nifty move in higher, and valuation again there is getting stretched. Is that a concern?
It's not a concern, and I think the reason it's not a concern so far is the fact that these are primarily under-owned stocks by a large amount of retail in this country. And number 2 is their results have been astoundingly good. Now, if you look at Bajaj Twins, look at the results. We're talking of 80% kind of growth rate. Even if you give a P of 40, 50, yes, it's excessive P. I would grant you that. And if any correction comes, you buy it up. But the fact remains that these counters are showing exemplary growth. The problem comes that when the biggest bellwether of this market, which is your HDFC Bank and Kotak Bank, which are the two-wheeler company which are showing so much of traction, they start to slow down. Let's see how Maruti results comes around, whether that has got a problem on the margin front because of given the discounts and the raw material price increase, whether they have a problem or not on the volume front, but on the margin front. So it's not, I would not worry too much with the performers. As I said, aggressive built up on performers is the right strategy for a market. This is a market for growth stocks. This is not a market for value stocks, because low valuations are coming from somewhere, and I think one place they're coming from is their low traction, their low competitive strength in the market, and therefore you do not want to go and pick those ones because the market is hostile to them, the environment is hostile, economy is hostile. You're not seeing any relief coming to those counters. The credit delivery system is going into further and further problems as we go down the path. You already seen the commentary of the MD of Kotak Bank, which says that the SME problem is now coming to the fore. economy takes time for things to happen. The demonetization, GST impact is now starting to come into the trading companies and the SMEs. Now, when that happens and the credit flow cycle starts to slow down, you'll see a lot more problems. So as I repeat myself saying, yes, you're paying higher for growth stocks, but that's still a wiser strategy than buying cheap the value stocks which are in trouble at this point of time and perhaps will go into greater trouble. So look for the revivals, look for the performers. Doesn't matter you bought a little extra, paid a little extra, you're a little late in the game, but at least be there so you will not see huge cuts in your portfolio compared to what we have seen the last 1 year. So don't worry about expensive stocks. Those are the growth stocks. Keep with them. They will be fine.
Ajay, it's difficult to make a sell call, if you will, allow me to use that term, on any of these performers, be it the Bajaj Twins, the HULs, Britannias of the world, or select banking names as well. The question is, could there be finally, could we finally witness a time correction in these names? We've seen that happen to the FMCG names for the better part of the period preceding this last 18 odd months. Could we see that happening to the large financial names, select FMCG names, the ones which are trading at this 50, 55, 60 times on a PE basis, or an astronomical 8, 9 times on a price to book basis?
Neeraj, you're right. The risk is there that you could see a time-wise correction, or at least remaining static doesn't give a great return to it. But if you look at the portfolios of customers, look back last 1 year. If you look at FMCG portfolio, you may be right that they haven't done exemplary well. They've given a decent kind of return. But then you compare to what's the mayhem all around you in the mid-cap sector. We're talking about 40, 50, 60, 70% kind of a bloodbath. So, from an investor perspective, you would rather trade in. I think that's the more important point. People have to understand that most investors that we deal with, or at least we advise with, we say, stable returns on a low risk basis is better than a high return on a high risk basis. It depends upon the profile of the customers. But by and large, most customers, in my view, would try to not to have a slash in the portfolio of the kind that we've seen, and would rather be happy with 18-20% return. Remember, we came from a background of 5-6% FD interest. Now it's 7-8%. So from 5-6% FD interest, if they were getting 14% return, they were a pretty happy bunch of people, maybe 19% very happy. They were not looking for 40%. Now the people who are looking for 40% are the ones who are in really the mid-cap game. And that's a game which I am told plays out over a period of 3 to 5 years. So it's 1 year is too short a duration to take a call whether the call was right or wrong. The number 2, it will see its own vicissitudes over time. Volatility will be very huge, so you need to live with the volatility. And therefore, while there could be a time-wise consolidation of these stocks, I would still believe you'll be a happier camper in this camp than being in the camp which can take away. And the next problem is in mid-cap is 2 of the stocks can be stellar, but 2 can be a disaster and they average out. So, you could have a great stock and then you have a weak stock and then you see what happens. You could have a PCJ in your portfolio which could wipe you out completely, all the returns and everything else. So those are the risks. So I am saying risk-weighted return in order of the day. Risk-weighted return tells us growth stocks is the story. You may have a time-wise consolidation, and believe me, if these stocks don't perform for the next 12 months, there is little hope that the smaller guys will perform. It's not going to happen. The leaders have to take the charge. It's like the infantry. The artillery has to move forward before the infantry can move. Infantry can't go ahead of artillery.
Yeah, well, that's well said. So, Ajay, then my question to you is, when you are now, if you are starting to buy now, I'm presuming that you would be, are you buying the ones which are on sale, 20, 30, 40, 50% off their valuation highs that they've clocked in, or are you sticking to the ones which have performed thus far? And if you're indeed buying the ones which are on sale, where is it that you're finding value? Where is it that you're finding possibilities of strength going ahead?
See, if you look at across every industry, there are stocks which still have tremendous value. Whether you look at pharma industry, which has got offering a lots of scope for value at this point of time, there are lots of stocks for value. Now, whether you look at auto ancillaries, there are a couple of names which are giving you value. You also had a very mediocre performance of Jai Bharat. You have exemplary performances of Minda, which will come around. Last time it was exemplary, maybe this time it will not be happening. So, it's not about pockets, it's about stocks. In every pocket, you'll find a slow mover, a dud, and a fast mover. And I think the trick is to go with that and don't do very fancy analysis. Just look at the June quarter results. Where you see a winner, go and place your bets. Yeah, you may have already lost 20% return on that one. Live with it, doesn't matter. You're not buying for tomorrow morning. But focus on the fact June is your indexes. If June result is not good, jettison the stock, get out of it. So my view is, and what we have bought and this thing is, that those are the pockets you got to be with. Number two, of course, is, the whole debate upon the biggest stock in this country, Reliance. Now you can have a camp. I'm not advocating buying Reliance because I'm not going to advocate any stock. But the fact is that can you live without the largest stock in this country? Fact is, can you live without the top 5 of the performing stocks in this country? Now that's why I said there the problem has come that 2 of the big stocks, HDFC and Kotak Bank, unfortunately did not show a stellar result of what they were expected, because one thought it will be a clean walkover for them. With nationalized bank in paralysis, they would report exemplary results. They have not. They are struggling for deposit. They have raised the rates over nationalized bank for the first time in a decade. Foreign bank and private bank rates of deposits are now higher than nationalized banks, and that's eating into the margin. So let's see how it plays out. But I would say June quarter result should be your trigger to say, if he's done well, I'm with the stock. If he's not done well, I'm not going to buy it. Maybe there is a turnaround. I don't care. I will not buy this stock.
I think this is the highlight of this conversation today with Ajay Srivastava. 2 things that stand out for me. Don't do fancy analysis, and remember, you're not buying for tomorrow morning. Ajay, it's such a pleasure having you as always. Thank you so much for taking the time out, and look forward to have you more often.
Wonderful having you.
Okay, we need to slip into a quick break right now. On the other side of this break, we decode the ICICI Prudential life insurance earnings with Managing Director NS Kannan, talked about the HDFC AMC, which is headed to the exchanges, the growth opportunity for these companies with Amit Jeswani of Stallion Asset Management and Siddharth Khemka of Motilal Oswal, and then try and talk about a couple of other numbers as well. Stay tuned to Bloomberg Edge Live.
Family businesses get a bad rap. Traditionally, they were looked down upon for getting rich any which way possible. Today, they're still looked down upon, but for very different reasons. For not being modern, for being too traditional and not being agile enough. I think it's easy to forget that the Tatas, the Birlas, the Ambanis, the Hindujas started off as humble family businesses. It's the way India has always done business. And it's the same all over the world. Walmart was a kirane ki dukaan once. I'm Sonu Bhasin. I've served as top management and as advisor to top management. I believe I have learned what keeps a good business ticking. Join me in a conversation with the stalwarts of the Indian family businesses, of building a business legacy that spans across generations. The Inheritors, an exclusive event by Bloomberg Quint.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here. There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that will sustain.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It
has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We are getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Welcome back. You're with us on Indian Open. ICICI Prudential saw its profit drop by more than 30% in the last quarter as higher advertisement costs weighed in on the top line. NS Kannan, who's just taken over as the MD and CEO of the company, says the numbers also need to be seen in context of a higher base last year. Dima Saxena caught up with Kannan and started off by asking him about the plan for the immediate future.
We have seen some increase in the cost to TWRP ratio. But it is also an outcome of actual choice we have made of growing the protection business. As you rightly said, one of the strategies, elements of the strategy is growing protection. Growing protection business, which gives us higher VNB, which also meets with the requirement of the customer, gives an ability for us to expand the VNB. So that has been the focus, one of the focus areas. And to be expanding this business, we had to invest. So partly we are in the investment mode, whether it is advertising, awareness building, all other expenditures related to that. That is something we had to invest. So if we split the expenses into the savings side and the protection side, the larger increase in expenses and the outcome in form of expenses to TWRP ratio, you would feel that happening in the protection business, not so much in the savings business. Yes. But at the same time, we are just starting out in the Q1, and you know the seasonality of this industry a little bit. So I feel that as we move along through the year, when some of the investment we have done in the past start yielding benefits in the form of volume, we expect the ratio to get better moving forward. So to summarize, we will invest in the protection business. Savings business, things will improve as the growth comes along, and we will continue to be one of the best in terms of the expense ratio going forward as well.
Under the same heading of productivity, I would also like to bring you towards the distribution channel, in which agency currently contributes to nearly 22%. Do you see that proportion increasing in the future as well?
I think one of the biggest strengths of our company is the well-distributed channel mix. I think that has been one of the key planks on which we have reached our products to the end customers, as well as that has been a basis for our operating in this market. I think that focus will continue. The bank assurance accounts for about 55% of our business. The balance, as you said, a mix of agency, not just agency, corporate agents, brokers, as well as direct sales to the customers. So it's a well diversified product mix, channel mix. And if you look at going forward, to answer your question, I think our emphasis will be across all channels. Our focus is going to be, as you said, the first P of premium growth. We will seek to get the premium growth across all channels. We don't have a specific target saying that the agency has to form X percentage of our channel mix. We don't have such a target. But suffice it to say that each of the channels, our endeavor would be to grow the premium income.
But
and whatever comes out,
the agency.
We have been recruiting. If you look at our own employees in the agency business, has gone up during the year. We started out the last year with about 12,000 plus employees, and as I mentioned in my interaction today, our employee base currently is 17,000. We have deployed them not just in the agency channel as well as in the other channels. The objective is to get benefit out of this deployment during the next quarters.
Has improved quite a lot to the extent of 34% year on year. If you could help us with the breakup of what was the contribution of protection versus ULIPs, and under the non-par bit, the savings and the protection side?
Yeah, the value of new business for the quarter, if you look at, yes, it increased by 34%, and we have articulated in the past that that is if you want to talk about a single part of our strategy, the outcome measure we want to track ourselves is expansion of VNB. So that has grown at 34% year-on-year basis. But within that, we have not really put out the split between the protection and other businesses. The VNB summary measure is the outcome of all the businesses underlying that.
Yes. When we look at the retail annualized premium equivalent, that which it contributes to nearly 96% of your APE, and that has fallen nearly 20%. And whereas on the same side, the group side, which contributes to a much smaller proportion, has grown, albeit on a smaller base of 61 crore to up to 134%.
Yeah.
So going forward, as part of your strategy, do you see the retail portion of your business coming down, whereas you would like to sell more towards the group side, since you also said that you would like to focus on the volumes?
Yeah, we will remain a retail dominated company going forward as well, and as I said, we have a large retail customer base which we access through the multiple channels we discussed just now. Retail mix may change a little bit here and there around a narrow corridor, but we will remain predominantly a retail company. Coming to the group business, to answer your question, we look at group business also as an opportunity. If I split the group business, there is a group fund management business, and there is a protection business, whether it is group term type of policies as well as the credit life, as a line of business. Because as you know, the retail loan penetration has been going up in the economy. The growth has been very robust in that business, and to protect the liability is a great proposition for the families. So we play a big part in that business, and then going forward it is one of the thrust areas. So these are the three areas of group business where we will going forward emphasize more of the protection business.
Under the credit business, do you see it more coming from the home loans or coming from loan against property, which is how it is for the other players in the market?
No, it will be the core of the business will be the first homes. If you really look at the first home loans will be the core of the business. That is where there is a huge proposition for the customers. And if you look at the thrust banks have been giving on this business, the NBFCs have been given on this business, the home loan expansion we have seen in the overall credit market, it gives a great opportunity for players like us who are operating in credit life business.
Absolutely. Talking about protection, which is also a part of your strategy that you've laid out for this particular quarter and going forward as well. What would be your outlook on the protection side? It makes about 8% of your APE for now. How do you see it increasing, and what your outlook would be on that particular side?
Yeah, if you look at that 8% itself, last year the number was closer to about 5%. It has expanded to 8%, but 8% also has to be put in the context of overall premium growth. So the 8% may go up and down, but I want to say that the protection emphasis will continue. If I look at over a medium term, the kind of opportunity we have, we feel that on the savings side, the opportunity for the industry could be around the nominal growth rate of the economy. That is the kind of, because given that we are underpenetrated as an economy, we do have at least that much of opportunity in terms of growth for the savings business. But protection, the underpenetration is even more. If you look at the protection as a percentage of GDP, any of those proxies, we are much underpenetrated. So we believe that the protection actually can grow much ahead of the nominal GDP growth, which I talked about in the context of savings. Our endeavor would be to take advantage of both these opportunities, and as both the businesses grow, whatever comes out as the result in terms of the protection as a percentage of the total, that we are happy to take that.
So as a percentage of APE from 8%, where
we have not
exactly?
set any specific target to say that 8 will go to 10 or any such thing. We have said that yes, protection growth will be ahead of the overall top line growth, and as a result, it is very natural to expect that it will be more than what we saw in the last year. I would only say that we should look at it over a period of a year, given the seasonality of the business, rather than looking at a one-quarter number in terms of the protection share.
Well, that's ICICI Pru, and remember the views are split out there. Santosh Singh believed that actually it was a good quarter and they needed to do the other expenses that they did. However, the stock under pressure early in the morning, as was the case with a bunch of other names, now has recovered the 400. So maybe the market did hear what Santosh Singh wanted to say. The next piece, and that's the country's second largest asset management company, HDFC AMC, has just hit the primary markets. The aim is to raise about 2,800 crores in an offer that will see the promoters, HDFC and Standard Life, cut their stake in the company. So does it make sense to invest in this IPO? After investing, does it make sense to stay invested in the IPO? Most people seem to be thinking so. Joining us now to talk about the IPO and the rationale behind the call to subscribe is Amit Jeswani, founder of Stallion Asset Management. In a bit, we'll also get in Siddharth Khimka of Motilal Oswal. Amit, good having you. Thanks much for joining in. Very interesting that you say that instead of putting the money in HDFC mutual fund, or any fund for that matter, go out and buy the stock of HDFC AMC. What's the rationale behind buying a company which has that HDFC brand name, but arguably is more expensive than the currently listed AMC, and will only get more expensive once the listing happens, if the grey market premium is to be believed?
Hi Neeraj. The thing with these companies are these are very high quality assets. So on my blog I had written this part that there are only few businesses in the world which work on brand equity. So they don't need working capital or fixed assets to grow. I gave an example of HUL. HUL had fixed assets of 1,500 crores in the year 2008, and that in the next 10 years, that 1,500 crores of assets have generated 42,000 crores of PAT. That's a lot of money. These companies are free cash flow machines. The opportunity size is huge, and you want to bet a leader in that big opportunity size. HDFC HDFC is the right bet. I think it's a secular 15% growth story. Obviously, there'll be cyclical ups and downturns with market conditions, but 10 years from today, I'm very convinced that the profits of this company will go up 5-6 times. The total profit pool of the mutual fund industry in India is just 4,000 crores. If you think about it, that's like $500-600 million. One hedge fund, just one hedge fund in the US market this year made a profit of $1.7 billion. This is not even the biggest hedge fund in the US. It's a mid-size hedge fund in the US. So the opportunity size in the next 5-10 years is huge. You're buying a shark in the ocean. You just buy and hold it for a long, long time. As far as the valuations go, IIFL Wealth, the deal happened of IIFL Wealth 1 month back, and IIFL Wealth was valued at about 15,000 crores. That is, and it made a profit of 400 crores. So that's about 40 times. So there is no reason why HDFC AMC will not get 40 times valuation. The IPO is coming at 32 times, but I believe it will open 300-400 rupees higher. And yeah, there's so much scarcity, like 2,800 crores of float for an HDFC. A few big buys and you won't get stock. So it's gonna be like a premium issue. That same things happened with HDFC Standard Life Insurance. I expect a repeat happening with HDFC AMC as well.
Interesting, Amit. So then my follow-up question is: does this argument go on to the AMC industry by and large? There are arguably 2 directly listed AMCs and then a couple which are indirectly listed. You could argue that some part of valuation ascribed to Motilal Oswal as a stock is also in part due to the AMC business that they have. Does this argument of the profit pool and the window of opportunity, or the size of opportunity, and the fact that the profit pool for the industry at large is just so low compared to what the global markets have, and at some point of time India could go there, does this argument extend to the entire space, or are you picking and choosing? Are you betting all your eggs on one basket, which is HDFC?
So all 3 of them are good companies. So HDFC, Motilal Oswal, and Reliance Nippon. The problem with Reliance Nippon is it's not the best quality management. Like, think about it. Someone just asked me the other day that Nippon is there, so what if Anil Ambani doesn't have a great track record? Nippon is there. So I reminded them that Reliance Nippon Life Insurance in 2008 had a market share of 7%, like the life insurance market share of Reliance Nippon Life was 7%, not the asset management company, the life insurance company in 2008. Today, the market share of Reliance Life Insurance is just 1%. Okay. At the same time, HDFC's market share has gone up 3 times. So, you know, when you bet for 5-10 years, you want to bet on undeniable, unquestionable, high-quality managements. And, you know, they'll like Nariman Point will be Nariman Point and Dharavi will be Dharavi. So that's going to be the case with the valuations of these two companies, I think. As far as Motilal Oswal AMC goes, I am a super big fan of Motilal Oswal AMC. I wish I could buy the AMC business alone, but if you buy the AMC business, you also have to buy Aspire. And I think they are, like Aspire is the housing finance unit. I think things are not going good there, and you will see a large spike in NPA. So, you know, as Bharat Shah of ASK once told me, that when you have a gruesome business and a good business, the markets give you the valuation of the gruesome business. And that's the reason I'm not able to buy Motilal Oswal. But at some day, you know, I think I would buy Motilal Oswal. It's a great asset, great management. And yes, so we're very bullish. Actually, our largest holding is also a stock which is in the financial services space. So that's there. See, these are great businesses. In India, the profit pool, see, in the financial part is divided in 3 parts: lending, protection, and investing. The protection and investing is just getting started. The total profit pool of your top 3 insurance companies, SBI Life, HDFC Life, and which is the third one? ICICI Prudential. The total profit pool is just 3,300 crores.
Yeah, I get your point.
Yeah, so the total profit pool is so small of these insurance plays.
No, I take on board the point, and which is where I want even the next guest to come in. I mean, I've completely in sync with your argument about the fact that the size of the opportunity is very high. The question mark only is if valuations are coming at a bit of a steep price. Now, compared to the listed entity, maybe they are, but as the guest pointed in the morning, compared to global peers, HDFC is probably coming in line with what the global peers are, and maybe that makes it a good bet. Siddharth Khemka, what are your thoughts here? He's, of course, the Vice President and Head of Research at Motilal Oswal, joining us on the show. Siddharth, what's your thought here? HDFC AMC, is your call a subscribe? And if so, is it a subscribe only on HDFC AMC as an individual one, or are you bullish on this space and large, and therefore you would have a bullish view on almost all of the listed names?
Yeah, good morning, Neeraj. Yes, so the 2 parts of the question that you asked. One is on the HDFC AMC. Yes, we have a subscribe rating, and that has to do with the pedigree of the management, the brand that they have built over the years. That reflects in the business, in the financials that they have got. So they have the highest market share in equity AUM, the most profitable AMC by far, and you have seen is among gaining market share consistently. So that's the call on HDFC AMC. On the overall AMC business, yes, it's a business which is growing, which is something that is picking up fast, and got impetus recently. Last 2 years, we saw the strong growth in the domestic AMC business, basically the mutual funds, where the financialization of savings have started picking up. So that is where the story lies as to the penetration of mutual funds right now. I think is just about 5% and has a huge runway ahead. So in that, as the previous guest highlighted, I think Amit was saying that you pick the best one. So right now, we had only one direct AMC listed available, but which was losing market share. Profitability was not as good as the others. So we are now getting just the second direct listed opportunity in the AMC business. Given
therefore my question, and to both of you would be, and Siddharth, to you first. For somebody who's got an investment in Reliance Nippon Asset Management, because when the IPO came out, the argument was that the space is growing, you don't have any other option, go out and buy it, even if you didn't quite agree with the valuations. Now my question is, for somebody who has an investment in RNAM, would you go out as far as recommending that if you had limited capital, go out, sell that money that you have in Reliance Nippon Asset Management, the business, and invest that for the HDFC AMC business? Would you do that, Siddharth?
So right now it looks like I would try my luck in the IPO. Given the small size of the IPO, it looks like that the allocation would be very difficult. I would not go away and straight away sell my stake in RNAM, so to say. We don't have a rating on that stock as of now. But I would be looking at the market once the stock gets listed. Any opportunity, I would like to stagger my investments and gradually shift from an RNAM to a HDFC. Having said that, right now, as I said, I was telling you that this is just the second listed player, and because of that, it is getting a huge scarcity premium. And if you see, most of the market participants are willing to give that premium right now. As and when the others, better players like iPru, SBI, Birla, they get listed, maybe that scarcity premium will come down. Nonetheless, till that time, the growth is there. But I would definitely put all my, at least in this space, especially in the HDFC AMC, all my money in HDFC AMC.
Very interesting. Amit, you know, that's the question then, right? RNAM benefited in part also because of the scarcity premium that still persists, and HDFC, aside of the fact that it's a great company, will also benefit from the scarcity premium. What happens when the others start getting listed? Because we are looking at the numbers, the revenue growth numbers, the net profit growth numbers, the AUM growth for HDFC are not bad. For ICICI AMC, they're just spectacular. What happens then? I mean, for an investor, I know it's too far out, we don't even know when it will happen, but my question to you is more this, that are you buying HDFC because of the scarcity premium attached to it as well, and will that go away once the other players come to the fore? Or by itself, you are happy buying and holding HDFC AMC stock for the next 10 years, irrespective of what else gets listed going ahead?
See, it depends on the valuation. If HDFC Life gets, AMC gets listed at 2,000 rupees or 1,800, see, it's possible. There's going to be a lot of scarcity premium. So the current grey market prices are 450. So we're already looking at 1,550. That's what the grey market is indicating. So a listing around 1,700 bucks is possible. And once the listing happens, I believe people will say that HDFC AMC is at 40p, 45p, Reliance AMC is at 25p, and probably the difference will reduce. But you have to get into the best quality ones. ICICI is number one. If I was an investor, for me the preference would be ICICI, HDFC and Motilal. So Motilal, like only the AMC business I'm speaking about. These are my top three ones, and these are the ones which will do well. But yes, in the long term, at some point of time, I will sell out my Reliance Nippon and get to HDFC. And I would play a basket approach here with ICICI, HDFC, Motilal, three players.
Gentlemen, I wish we can go on with this. On purpose, I didn't talk about the financials because it's irrelevant. We all know that the issue will get subscribed. The question mark only was, what should an investor behavior be like? Yes, go out and subscribe, because almost everybody said a subscribe. The premium seems to suggest that you will make money even on listing, forget over the next 10 years. I just wanted to get a sense from you as to how would you approach this space, not just now, but over the next 5 years. Thank you so much for taking your valuable time out and speaking to us today. Siddharth Khemka as well as Amit Jeswani. Good having you. Amit, we'll see you at the Alpha Ideas Conference on Saturday. However, the last piece on Indian Open today is music broadcast. The higher ad rates have aided music broadcast numbers in the first quarter. The company managed to hike rates across 12 circles. The question mark is, can this trend continue, or will this price hike be enough for the rest of the year? And the government is expected to increase its spending now that elections draw closer. What would that do to the business as well? R.K. Agarwal, Group CFO of Jagran Prakashan, the parent company of Music Broadcast, joins us right now on the show. Good having you, Mr. Agarwal. Thanks so much for joining in. Before we talk about the numbers, just first up on the buyback that's been announced, what's the rationale there? Why have you done this quantum of buyback and the price that you've done it?
We could not distribute dividends because of legal constraints, and following the group's policy, we believe returning the surplus cash, whatever we are generating from the operation. So whatever we are giving back, that is nearly 70% of our cash generation from the operation.
Okay, fair call. And therefore, this buyback in order to reward shareholders. Okay, point taken. What about the business? That you induced a rate hike in, I think, all of the core markets that you operate in. Was this
that is right.
the only price hike that you would undertake this year, or do you believe business is looking sound enough for you to probably squeeze in a hike or two more during the course of the year?
We do not think that we would take further increase in the prices. In fact, in the first quarter, what has happened and what has gone good for us was not only we were able to absorb the increase in the prices in not too conducive market conditions, and number two, our phase 3 strategy has played out very well, because there is a good traction in new stations which we had set up. And in fact, in Q4 they had broken even, and Q1 they have contributed positively in EBITDA. So that is something which is at least 2 years ahead of our expectations, and both these factors put together have delivered 25% growth in PAT and 17% growth in EBITDA, which is industry best, I'm sure.
Okay. Revenues grew about 7%. I can understand the margin expansion was good in part due to the rate hikes as well. But revenue about 7% was this satisfactory, or would you believe that the quarters ahead, because of the election season and otherwise, could actually show you a bigger bump up?
Absolutely right, you are. Revenue growth is around 8%, and Q2 should be doing still better. And of course, all the media companies have a lot of hopes from S2, so we too also have a lot of hopes from S2. So we are going to, as the years pass by, do better and better only.
Yeah, but could you give some numbers there? If you've done 7.5 in Q1, as an average, would you nudge double digits?
On an average, in fact, expecting the good government spend in S2, we expect around 14 to 15% growth for all of the year, which means a very, very sharp increase in the PAT as well as EBITDA.
But if you expect 15% for the year, Mr. Agarwal, the ask on the next 3 quarters is very high, because you've done about 7.5 this quarter. Does the strong show start in quarter 2 itself, or would quarter 3 be the pinnacle?
Yes, Q3 and Q4 should be giving very, very decent, growth rates. But even then, they do not give it to that extent as we are expecting. 12 to 13% is something which is very easily visible.
Margins at about 34-35% are maintainable, or would you better them?
Yes, of course.
Okay.
We would say we will be able to maintain, margins above 33%, which is again beyond our expectation.
In which case, I would presume that the net profit growth would not remain at 25%.
Yes.
It would be what? You expect about a 35% profitability growth, or higher than that?
It would be more than 25% in case we deliver these numbers in top line, of course.
Wow. Okay. That's for music broadcast, of course. The Group CFO of Jagran Prakashan, the parent company, speaking about what MBL could throw up. Good to have you, Mr. Agarwal, and all the best for the quarters ahead. Thanks so much for taking the time out. Let's pull up the stock of music broadcast. There is a buyback in place, and the management commentary is very, very strong for what the quarters ahead could throw up. Watch out. They are saying that the revenue growth would be nudging that 15% mark for the year, and therefore quarter 3 and quarter 4 the numbers could look even better. Margins would stay steady state, 33-34%. Profitability for the year on average would be higher by about 35%. They've done about 25% this quarter. Therefore the ask rate or the delivery rate on profits as well for the year ahead could be very strong. That's music broadcast for you. Fairly bullish commentary. Nevertheless, that's all the time that we have on First Word, or Indian Open rather, for the day today. Thanks so much for watching. Up next is the FNO show with a bunch of management conversations on earnings as well. So do stay tuned to Bloomberg Quinn Live.